It's more like a commodity rather than a company. For most long-term investors, this one's going to significantly lag versus VU. So these companies are ones that have really consistent cash flow that can then pump it back to investors rather than investing to grow their business. D tier. And this is probably one of the most popular ones you're going to hear thrown around, especially like in Robinhood, Reddit circles.
Hey Alex, how you doing?
Doing great, James. How you doing?
Doing great. You ready to talk stocks and more?
Yeah, let's do it. Let's go forward here with a nice tier list.
Yeah, speaking of, I'd like to run you through some tier ranking lists specifically today around ETFs so we hear your thoughts about some of the most popular ETFs.
Let's get right to it.
First off, maybe we level set with the group. Can you explain what an ETF is?
Yeah, so an ETF is basically a collection of stocks that is treated like it's a single stock. So what it allows you to do is diversify by owning just one position. And we'll talk through, there are so many ETFs that you can buy out there, but we're going to be talking to some of the more popular ones today.
Okay. So it trades like a stock, but it's really a collection of stocks that gives you some exposure against each of those.
That's right.
Okay.
And the catch with it is that you have to pay fees.
Mm,
So there's somebody that manages all of these funds, and some of them are actively managed and some are passively managed, meaning that some of them have guardrails that they automatically adjust when stocks rise and fall. Other ones are up to a manager to pick which ones go in there. And so basically, one rule of thumb is if it's managed passively, it's going to have lower fees. If it's managed actively, it's going to have higher fees. So that's something important to keep in mind.
all right. So there are some fees associated with the management of that fund. Obviously, if it's actively, then they're deciding which one should be in it or not.
Right.
Passively, not so much. How is the fees calculated against that expense ratio?
So you'll see the fee is a percentage of what will they take based off how much money you've invested.
Mm,
So in the instance of 0.03, they're only going to be taking 3 cents out of $100 when you invest in it. It's basically nothing.
mm.
But if you had 1%, they'll be taking $1 out of that $100. So you can see how the fees really matter and it can really impact your gains for the long term.
All right, so that's helpful. What is the benefit of an ETF versus just finding the stocks within the ETF and purchasing those stocks directly and avoiding any ETFs at all or ETF fees at all?
So you technically could do that.
Mm,
It's just some of these ETFs have literally hundreds or thousands
mm.
of positions that go into it. So it would be so time consuming for you to go through and do that, that you're just way better off just buying the ETF. And like I said, some of these are actively managed. So you're also having a professional choosing the allocation on some of these. And they might have better information than you or be making decisions that you're unaware of. So I think that having that with the ETF, those are the pros of why a lot of people choose it. And also why I recommend that 50% of your allocation of your portfolio should be ETFs. I think they're pretty awesome.
Right. Yeah. When we had talked about that, but for somebody who maybe hasn't caught up, I do encourage you to take a look at some of our previous videos where we deep dive the benefits. But I believe one of them is it prevents or helps you from experiencing too much of a pullback. If one individual stock maybe pulls back because they had a bad day or something happens, it doesn't impact you directly to that same level. Is that fair?
Yeah, depending on the type of ETF it is, it can be really a anchor for your portfolio where those major pullbacks happen. If you have ETF exposure that's broad, you don't feel them as much. So that's why they're so important in your portfolio.
All right, great. So it aggregates some stocks, simplifies the investing, provides a little bit of dampening on big market swings, depending on the ETF, of course, and what happens in the market. All right, well, let's dive in and see what you got for us.
Let's do it.
All right, so the first one, QQQ.
So QQQ is A tier, and QQQ basically follows the NASDAQ. And so the NASDAQ, as you might be aware of, is tech heavy. So if I'm a tech investor, this one's going to be investing in the NASDAQ 100, which is basically tech. And it's an awesome position. We know tech has been outperforming largely. So this one has been outperforming the total market for a pretty long time. But it's a little bit more volatile than if I was just investing in an S&P 500 index.
Right, because the S&P has more than just text. This is primarily text. So something market wide or sector wide happens in tech, that one's going to feel the impact versus a more balanced S&P 500 index ETF.
That's exactly it.
Okay,
Yes. And
great.
you'll see recently QQQ has been outperforming and NASDAQ has been outperforming because a lot of the growth that we've been seeing within the stock market has been tech companies leading
Right,
it.
with the AI build out and all of that.
Right.
Next one is ARKK.
Yes. ARK is D tier.
Mm,
And this is probably one of the most popular ones you're going to hear thrown around, especially like in Robinhood, Reddit circles. ARK Investing is ran by a lady named Kathy Wood, and she has some pretty wild speculative plays and some insane swings that she goes into. You pay really high fees.
mm.
And if you look at performance for her, she's usually missing the market by quite a lot. But she has quite the selling story and marketing for it. And that's why it is pretty popular and you hear it thrown around. And all kinds of news stations love talking to her because she always has really strong views on really speculative tech companies.
Right. In comparison, the QQQ is 0.18 expense ratio and ARC is, I think, 0.7 something. So it's vastly different in the sense that it's incurring a lot more fees to have it.
Right, exactly. You really are paying her a bigger fee to be really handpicking really niche tech companies. So it's extremely volatile. It's just not for me. You're way better off in some of these other ETFs that we're going to be talking about.
All right. That's an interesting take. By the way, if you're listening or watching, we'd love to know if you disagree or agree. Pop a comment in there. We'd love to hear your feedback. All right. Next one is VOO.
VOO or VOO is S tier. So this one follows the S&P 500. It has super low fees, 0.03%. So basically, you're not paying almost anything to be in this one. And it covers the S&P 500, basically the 500 largest companies. This one's really stable. It largely tracks with how the market is performing. And another one of these that you can really anchor your portfolio to. And it's a really good starting investment for a lot of people.
Right. So this one is leveraging the index, so the S&P 500. And so it's probably why the management fee is less because they're not actually managing it. They're just saying, "Hey, we're using the S&P 500. The S&P 500 manages itself, who's in, who's out." And so we're just investing into those 500 companies and you're getting that through this ETF, right?
Exactly. So this is an example of a passively managed fund, and that's why the fees are so low. These are the favorite ones to own for me.
Right. And so this makes it easy when people say, hey, just pick something like the index fund. As most people, when they try to get crafty and pick individual stocks, often don't beat that gains that an S&P fund naturally gets. And so this seems to be like that comparison that everyone says, well, did you beat the S&P 500, etc., right?
That's exactly it. So when people throw out, are you keeping up with the market? This is usually the one that they're talking about. And what's pretty crazy is a lot of stocks do not keep up with it.
Mm.
So most investors are often way better just to own the S&P 500 index, and VOO is one of the best because the fees are very low.
One reason ETFs are efficient or beneficial is versus like a mutual fund, which is similar, but the fact that it's traded like a stock, you can pick and choose, buy, sell throughout the market day versus like a mutual fund where you only purchase it at the end of the day, 4 p.m. Eastern time. So I found that kind of interesting in why previously mutual funds were super popular, but this is like an updated mutual fund with more flexibility.
That's right. And really, mutual funds, you're most likely going to be only finding within your 401k. So
Mm.
for most people nowadays, you're exactly going to be in VU doing ETFs as a normal stock and not the mutual funds.
All right, let's take a look at the next one, SOXL.
SOXL is C tier.
Mm.
And this one is a triple leveraged index fund,
Hmm.
meaning that it moves at 3 times the leverage versus the underlying stocks. And this one makes it so it becomes very volatile when either things are going up or when things are going down. And this one specifically follows the chip companies itself. So you're going to have NVIDIA and stuff like that in it. So if you've been in this one during the huge chip rallies, you're probably up massively. But this one also has really high fees. So it has 0.91% fees. So you're losing a lot of money because this one is such a special type of ETF. But when it's working, it's really working. When it's not, this one's going to crash. So this one's not meant for most investors.
So it sounds like that might be if something's hot and happening in the market and works short term, but maybe not so much for a long term investor.
I think that's right. Yeah. So this is really not the kind of ETF that I would be recommending as a long-term investor. If I'm more of like the day trader type and I'm trying to take advantage of like a rally or something like that you're seeing or expecting, this one can help you get really short, quick gains and then you get out of it really quick. I think that's how most people would leverage it.
All right, next one is QQQM. I think similar to the first one we looked at.
That's right. So this one is S tier.
Mm.
And this thing follows exactly the same NASDAQ that QQQ also follows, but it has lower fees.
Mm.
So if I'm just buying something to hold, I'm always going to buy the one that has lower fees. And this is why long-term investors should be in QQQM and not QQQ.
Speaking of, I've noticed that depending on if you're in using Vanguard as your broker or using a Robinhood or using Fidelity, some of these also have their own funds that may overlap. Is there a benefit, for instance, if you're Vanguard to stay within the Vanguard world and get a VTI versus some other one that's similar?
That's an interesting question. And really, my thing would be if it's covering the same thing that the mainstream one is, and if the fees are lower or the same, you can be in those if you would prefer to be in those. I don't think there's any advantage though. And the only time that I would think that that would be the case is if you had one that's specifically like in your 401k or something that would have special allocation because it's in your 401k and the fees would be then lower and then you should be in that one. But in terms of general versus the specialized ones, I always would say just pick the one that has the lower fees.
All right, next one is JEPI.
JEPI is C tier. And so this one is focused on income. So think of really high dividend paying stocks. So this one's great for passive income. But what happens with this one is you can start lagging the market. And the reason why you lag the market is because generally when the dividends get really, really big, the underlying stock does not grow that much. So you're really investing in more continuing income streams rather than I'm buying the stock to hold and grow with it. So it's a special use case rather than a general purpose ETF.
Yeah, that makes sense. So we talked a little bit about some of those different types of stocks. For instance, you have value stocks or growth stocks. Sounds like this ETF is focused on the value, which they're not investing that profit as much as returning it back to the company owners or the investors versus trying to build out some new product or market or whatever.
That's right. So these companies are ones that have really consistent cash flow that can then pump it back to investors rather than investing to grow their business. So that allows you to then get consistent dividends. So depending on the life stage you're in or what your goal is with your portfolio, this one can be good if you do like the dividends. But for most long-term investors, this one's going to significantly lag versus VU. So I would much rather have you in VU rather than JEPI.
And just thinking out loud, I almost feel like there might be a strategy that these come into play where if you want to take a little bit less risk, maybe similar to leveraging a bond, you get a ETF like this that gives you some defensive capability in your portfolio. You get some dividends. You're not growing as much, but you're also getting that cash back, maybe even acting like a high yield savings account or something.
That's right. So really thinking of this as a defensive play
Mm,
rather than a growth play. I think that's a really good way to look at it. So if the market is going down, this one might outperform the general market. If the market's going up, this one's probably going to be lagging the market.
I see. All right, next one, VTI.
This one is S tier.
Mm,
And this is another standard cornerstone ETF that most investors should own. And this one owns the total stock market.
mm.
So my recommendation is generally either pick VTI and it'll own the total market, or pick VU and own the S&P 500. The largest companies really drive the total market in general, but these ones perform extremely similarly and they'll be off by a marginal amount. So really it's up to you. Would you rather be in the total market or the S&P 500? But this one is another must own.
I've learned too that the total market, one of the benefits, it allows you to reap rewards if like a smaller cap or mid cap company is doing well or there's some innovations there that is moving the needle in the market. It's a little bit more exposed in the total market fund versus just the big 500, if you will, with the S&P 500.
That's right. So if the market is growing really well, and it is kind of like those new and up and coming companies that's driving, the total market is going to outperform.
Mm.
So it is really interesting. It's very nuanced as you start thinking about how you want to allocate your portfolio. I personally generally go with VU, but there is nothing wrong with VTI. And recently, when you're seeing like the chips coming up and playing and all these emerging technologies, maybe VTI is a better idea.
All right, next one, TQQQ.
This one is D tier. So this is again a triple leveraged version of QQQ. So
Mm.
basically, this thing moves 3 times as much as the underlying QQQ would move. Highly volatile, really not meant for long term. It's more about capturing short term momentum.
When you say leverage, what exactly do you mean?
When I say leveraged, what it means is the way that it's designed is that you're getting 3 times the exposure that you would get if you normally got the underlying stocks. So, for example, if QQQ moves 1%, this one moves 3%.
Mm.
So you can see how explosive it will be if, you know, this is, will not happen anytime soon, but if NASDAQ moved 10%, this will be moving 30%. So
Mm.
you can really start like doubling, tripling down on like how aggressive you're being when you pick these. And that's why from a long-term investing perspective, I would not want to be in these because they have really high fees as well.
Right, but if you happen to time it, for instance, if this had like some of the semiconductors before they had their, last year's run up, you could really benefit from that. But if it's on a big pullback, you're getting a 3x pullback as well, right?
That's exactly it. Yeah.
Mm.
So this one would have a lot because it is tech. So it's going to have a lot of those chip companies that have been really crushing the memory. So that would have been great plays when the momentum is right. But as soon as that shifts, that's when you're going to pay the price for being in these.
All right, another popular one, SMH.
SMH is A tier. And this is one of my favorites because it allows you to get exposure to a lot of those chip companies that we've been talking about. Your Nvidias, your AMD, memory with Micron, they're all in there. And the fees on this one are a little bit high, so that's why it wouldn't be considered S tier. But this is one of my favorite ways to get exposure to. If I believe in AI and that whole trade there, this is a great way to do it without having to buy each of the specific companies that are benefiting from that.
All right, next one is SPY.
This one's really popular. SPY is B tier.
Mm.
And the reason why it's B tier is I would rather have people in VU because the fees are higher in this one. So instead of a 0.03, I'm paying a 0.09 for the exact same companies. So why would you ever do that? There's a lot of people that have been in this one and, things have moved forward and fees have become like cheaper. So maybe you're in SPY just because that's how it's always been. VU is better. And again, it's not major differences, but why ever pay fees more than you have to pay them? We want as low as fees as possible.
Yeah, that's fair. So, adjacent question here or relevance. So, to your point, let's say you're in one and it's got an X fee, and you learn about another one that's got a better fee. Is there a strategy, a right time, wrong time to make that transition? Is there abruptness that you want to avoid? Do you dollar cost average out of one and into another? Or is it okay just to sell this 100%, everything, all my positions sold, take that and reinvest it into the better one? Is there a strategy there?
So this one's a little bit complicated because it depends on what your gains
Mm,
look like. So if I'm selling my stock, that is a taxable event. And the fee differences on these can be really small, like 0.06%. So if I'm selling my stock and I've not been holding it very long, that can be triggering pretty significant ordinary income uh, taxable event.
hmm
That's huge money. So simply by selling it, I'm going to owe the government 30% plus of my money of the profit. And I'd rather you just stay in it and then from there maybe start buying the other one that has lower fees and just add it on to it is what I would probably recommend rather than transferring over to it. The only time I would not recommend that is if the fees are drastically different on there. But again, whenever you're selling, it's a taxable event. So you have to really pay attention to your taxes and what's going to be happening before you ever sell.
Right. And so maybe if you're recently done this, want to make the adjustment, maybe stay aware of a dip where, you're either break even or just below, make that migration at that point. But otherwise, keep it and just start rebalancing your portfolio, it sounds like.
I think so. Yeah, because when we're talking the fees, I mean, again, these are fractions of a percent. So it's really going to only impact you, after many, many decades of being in them. And if you're noticing it, especially early on, it's pretty easy just to start moving your money and adding to it rather than selling.
Okay, that's fair.
Yeah.
Next one is SCHD.
SCHD is A tier.
Mm,
And this one I really like because it's a dividend growth ETF. So these are companies that have good dividends, but unlike JEPI, they are focused on companies that continue to grow their dividends. So think of like your Qualcomm, your Coca-Cola, the companies that are really steady long-term businesses that they've increased their dividend over time. And the reason I like SCHD is not only am I getting a dividend, there are companies in here that have grown really well over time. Now, granted, this is more of a defensive position. This one will lag the market most likely when it's in high growth mode. So that's where your QQQM is going to outperform this one. But if we're getting big pullbacks, this is a nice safety net along with VOO to help stabilize your portfolio.
right. Okay, and when you say laggard, you mean like maybe the market's climbing 10% in a sector or something like the AI build out and all this attention and companies spending to make that happen,
Mhm.
meaning they might grow 10%. Lagging means like, hey, this one's an aggregate, so it's got other stocks in it that are not as performant, so it's only going to grow like 4%. Is that fair?
That's right. So
Yeah.
you're going to think of it you're going to be a couple points behind the trend of VOO.
Right.
Now, the great thing is you are getting a dividend, and the dividend on this is going to be significantly higher than what you'd be getting from VOO. So over time, I think SCHD will likely keep pace or just behind what we're seeing with VU. But really, when the market continues to grow, that's when you start seeing that gap really widen.
Yeah, and I think the dividend aspect is great because it's either you could, especially if you're a newer investor or younger investor, you could just turn that dividend back into reinvesting it, and that helps grow and compound that. Or maybe you're a seasoned investor, you're near retirement, or you're retired. You could take those dividends out as usable for your living expenses and things like that, while still owning the same amount of shares or stock, right?
Yes, that's the beauty of dividends is it really is flexible. You can use them as like extra leverage to continue to buy more of the stocks or as passive income like you're talking about. So, depending on the role of your portfolio, this one could really play a nice fit into whatever you're trying to get done.
All right, next one is IBIT.
IBIT is D tier.
Mm,
And it is D tier because it basically is a index fund that's designed for Bitcoin. It basically mimics Bitcoin trends, except I'm paying a fee. So, my opinion is if you just want to own Bitcoin and you want Bitcoin exposure, just get familiar with crypto and get buy your own Bitcoin. That way, you don't have to pay the fees. I think it's very silly for people to be having to pay fees when I can just simply go buy Bitcoin.
yeah, and this fee is not inconsequential at 0.25.
That's right. Yeah, and I mean, Bitcoin is volatile enough as is. And if Bitcoin's pulling back and I'm having to pay a fee on the pullback on top of it, like it's like insult to injury kind of things. If you believe in crypto and you really want to be in Bitcoin, just go buy Bitcoin.
Yeah, I feel like within Bitcoin, there's one major Bitcoin, and then there's all these altcoins that really don't move the needle. And so, being in one that's aggregating all the altcoins, if you will, don't quite make as much sense to me, at least, versus a aggregate stock ETF or something. Again, that's just my opinion. I have some friends that have made money on Bitcoin, but I've personally shied away from it.
Yeah, and I mean, it's really fallen from grace recently. I mean, it was over 100,000 there. You know, it's been floating in the 70s, right around 80, and it's kind of like in nowhere land. And it's kind of funny that we haven't heard as much about it because chip stocks have been crushing so much.
All right, next one, GLD.
GLD is B tier,
Mm,
and GLD basically is a way for investors to be getting invested in gold.
mm.
And gold has a very specific role in your portfolio. It really acts as a hedge against downside. We saw this really early in this year when there was a lot of volatility. Gold and silver were really growing. And so if you were in GLD, you were definitely outperforming the market to start the year.
Mm.
B tier means that it could be in your portfolio, but it isn't a necessary thing to do. And to me, GLD is very role specific. So if you want to have a hedge, if you're interested in gold, feel free to do it, but I don't think it has to be as part of your portfolio.
That's fair. That's fair. And when you own that ETF, GLD, do they actually ship you some gold?
No, they do not. But maybe that's another one that we could start where we ship
Right.
people.
Yeah. So is it that you're actually just investing in a company that owns the gold?
Yeah, so this one's really interesting
Mm,
because it's more like a commodity rather than a company. So the fund is actually buying gold and you're investing in the fund, and then the fund tracks with the price of gold because the fund owns gold. So it's different. It's really a material or commodity that you're investing in rather than companies. So it is kind of unique versus some of the other ETFs out there.
basically makes it easier to buy and sell too, because I'm not saying, hey, I got 5 ounces of gold, who wants it,
Yes.
and putting it on Facebook Marketplace or something. Um,
Right.
so that makes sense. All right,
Yeah,
so that's
you don't need to take that gold bar down to Pawn Stars anytime soon with
right,
this one.
right.
Yeah.
I saw recently you could buy gold at Costco, which I thought was wild. And then when was
That is
gold was running up, people were like bonkers for it.
what's funny is that they actually raised the prices on it because gold prices actually went up. That thing sells out so fast. I wish Godspeed to all those people buying those bars.
Yeah, but then you got gold in your house, and now you got to worry about protecting that.
Yeah, I'd much rather be in GLD. That I'll pay those fees gladly than having to worry about hucking around gold on my
Right.
behalf. Yeah.
Right. All right. Well, that one's fun. Let's move on. Next one is VWO.
This one is B tier. And so this is going to be covering emerging markets. And emerging markets are basically stocks that are overseas outside the US. But there are some major companies like Taiwan Semiconductors is part of this one. So there are some significant large players that are in these. And it can really outperform the market. If you ever hear people talking about emerging markets outperforming, really they're talking about companies outside the US are outperforming.
Mm.
So this another one is one that is a very specific role that if we're seeing a lot of investments and a lot of success for companies outside the US, this one covers that really well.
Yeah, and especially when you think of these companies with this new, not new, but a global economy where we're getting chips from South Korea or Taiwan or these places that are making inroads with technology. It sounds like a good ETF to have.
That's exactly it. So if you believe that they're going to continue to outperform and play a really big role, this is where that ETF helps you get exposure to those companies.
All right, the next and final one, VUG.
VUG is A tier,
Mm,
and this one focuses on big technology companies. So it's kind of similar when you're tracking with Nasdaq, but it really focuses on the large companies. It has really low fees. It's a good way if I think that technology is going to outperform, that if I just get this one, it's going to be a good way to cover a lot of those companies.
that's great. That's great. Well, thank you for taking us through your tier ranking of some popular ETFs. And again, maybe to summarize, how do you see ETFs fit within a portfolio um, in a kind of a balanced method?
Yeah, so my method is that your portfolio should have 50% of your total money allocated in ETFs. And specifically starting with those ones that we have ranked S tier. These are the ways that you anchor your portfolio and you diversify it so that it's more safe and less volatile compared to only investing in individual stocks. So I would look at this list as a great place to start doing my research of which of the S tier ones do I want to pick. Is there anything with an A tier or B tier that I think could be a nice niche or cover point that I want to do? And then fill out the rest of my portfolio with individual stocks. And we have tons of videos for everyone to go check out if you want some recommendations on what are some of the other stocks I could be thinking about for my portfolio.
Alex, well, thanks for talking stocks and taking us through your tier ranking for ETFs. We have a few more tier lists coming. I encourage you to like and subscribe. We also got a newsletter coming out soon. So if you're interested in that, you can go to alextalkstocks.com and at the bottom, just share your email and catch that when we release that. Also, of course, you can email Alex anytime at alex@alextalkstocks.com. So thanks for talking stocks today, Alex.
It was fun. We'll talk to you soon.
Likewise, take care. Talk soon. Ciao.